First, check your money. You can see the Dow board there, just a handful of Dow stocks up. Goldman Sachs now the biggest loser, but stocks overall the index in triple-digit loss. Joining us now, Fox News contributor Scott Martin. Scott, I'm saying that the Federal Reserve is the biggest risk to the market and to the economy right now. What do you think?
You're pretty close, Charles. Federal Reserve may be public stock market enemy number one, but there are some others. And I think it's frankly, Charles, the market's mood, really. It's the fact that psychologically, the market's not in good shape. And this goes back to, I think, maybe early November when you had some of those nasty reactions to good tech earnings, Netflix, Adobe come to mind, where the market just didn't seem to take good news well. And so, yes, I think to your point, you mix in a Fed that is, I believe, going to be at least attentive, Charles, to say the data that's coming out. But as you know, the data is getting hotter. Inflation data is starting to tick up a bit, wages and so forth, CPI. And so that's another player in this market that seems to be affecting psychology.
Well, we had a pretty good week last week with the Dow, pretty good, nice bounce back. And it felt like we were getting some equilibrium. So what exactly would the market need to see, Scott, to sort of resume that upward climb?
You know, I hate to say this, and you know this being a trader like myself and a money manager too, Charles, the market needs time. It needs time to recover a bit from, I think, a lot of the explosive events, let's say, that have happened. I mean, look at this. You know, we've got a couple of recounts going on, some fights certainly with respect to the midterm elections. Last week was a big week. You know, the market ran up really fast and then kind of fell back really fast, so it's maybe out of breath a little bit. So I think some time to just digest and maybe just at least settle out as to where we are on the charts. You know as well as I do, Charles, 2750 or so on the S&P is a pretty big level to watch. So the market needs to kind of just take a breath or two and figure out where we are and where it wants to go.
Do you think we have to test some of the recent lows then to sort of confirm the worst is over? Because, these retests, certainly in the month of October, just led to more downside. And it also, Scott, beyond the charts, I'm looking at Goldman Sachs, for instance. I cannot understand why these financials have been such underperformers, and I'm wondering if there's some sort of canary in the coal mine with the entire economy.
There could be. The financials is a great point. I mean, how many times, Charles, and not so much you and me, but how many times have we heard on other media outlets or other experts, let's say, talking about this is the year for financials. Financials have bottomed. This is it. Rates are going up and financials are going to make it happen. I just don't see it. Now, the settling point of that is financials haven't carried this market for years. So I'm not totally sure that this market needs financials to start carrying it, although I think the market is looking for new leadership.
But does it need something? Right. I'm glad you brought that up. The idea is if tech doesn't lead it, if the big names that carry communication services, consumer discretionary, and tech, those big names falter, what could carry this market?
Well, I'm looking at two areas, and they're two areas that we've started adding to. One area we've had for a long time, Charles, which is healthcare. That's been pretty strong, and industrials. I mean, at some point, industrials have to perk up here, whether it's a China trade deal or just on a valuation basis alone, looking at, say, Cat and Deere and some of the names we own for ourselves and our clients that we started picking up here on some of the lows. I mean, Charles, those names have to start perking up. But the problem is with some of these industrials and some of these multinationals, as you know, you've been pointing this out all morning, the U.S. dollar is so darn strong. A lot of these revenues that come from these companies I just mentioned are overseas. And so when they get repatriated into dollars, they get blasted because the currency domestically here is so strong. That's another headwind that's perked up in the last couple months.
Technology now down 2.8%, the S&P tech sector. And it's, Fiserv, it's Juniper Networks, it's Paychex, these aren't necessarily household names. Of course, Apple, the biggest name there, and over 20% of the index. You brought up the point that we need time, but this feels like a market that's not going to just drift, right? It's moving violently, either to the upside or downside. So that's the fear, Scott, isn't it, that if nothing intercedes here, new lows begat new lows, but at the pace that we're going, we're talking about at some point major panic.
Well, I don't know if we're going to see panic, but I do think you're right. Lows usually selling begets more selling, as frankly, Charles, buying begot more buying, if that's the right way to say that, last Wednesday, after the midterm elections. Here's the thing, though, too, to consider if you're playing at home. we're coming up to a Thanksgiving holiday week. So, some of the volume, frankly, on some of these down days has not been impressive. So what I would tell you is that's probably sellers, algos, computers, whoever, pushing it down a weak volume market, which is easy to do, and something that probably means there's no conviction in that move. However, if you look at, say, next week, the volume's probably not going to be very strong either. So, seeing how this period pans out, Charles, between Thanksgiving and Christmas is really key, and I think we're going to see the volume come back, and that's when you're going to have conviction one way or another, upside or down.
Scott, thank you very much, buddy. Always appreciate it.